Hello and welcome to Lipper's Fund Flows Insight Report. I'm Jeff Turnahoy. For the weekend of December 11th, 2013, the conventional mutual funds industry saw widespread outflows activity, saved only by a little bit of short-term inflow activity for money market funds. Let's take a look at the big picture and see what happened. Starting off at the top here, we can see that equity funds had outflows of about $6.5 billion. We have some information on that to add some definition around it. We also saw taxable bond funds encounter outflows. This week, about $900 million was pulled from them. Municipal debt funds had a whopping $1.9 billion removed from them. And the only bright spot this week was money market funds with $2.8 billion in inflows. Well, turning our attention to the bigger picture, we also saw that there were a number of developments this week that may have caused the equity flows figures to look a little large. Well, we clearly see that there were outflows this week on a number of products. We also acknowledge that it's an awkward time of the year where we do have a lot of distributions, and the timing of them can present some awkward moments in the data. Overall, though, with about $6.5 billion, it's suggesting to us that perhaps equity investors are trying to get a jump start on tax planning this year, and some may be dumping equity funds in order to get out from underneath a tax liability after a good year of performance. Well, we also saw, as far as economic news, tapering talk starting to heat up on Capitol Hill, and with the Fed Reserve meeting next week to talk about that, investors are maybe acting a little bit wary of what might happen next week. We saw the market generally flat to maybe a downside slant to it. The economy seems to be in a good picture right now. Unemployment was down 0.3% to about 7% even. That's about where Bernanke hinted at earlier that tapering could begin. But with the budget agreement on Capitol Hill just recently reached, it also came with no agreement on the debt ceiling, so it likely means we're heading for another showdown in February. So markets may be pulling back a little bit, figuring that the last time we had this kind of gridlock in Congress, it didn't work out so well for the market. So overall, the best draws this week for equity mutual funds were international large cap core funds. They had about $511 million in inflows, while long short equity funds also took in money this week, as they've been doing pretty well this year. They took in about $309 million. Well, the next group we can take a look at is equity ETFs. Here they had about $4.7 billion in inflows this week, so quite a bit different from the retail crowd. SPY led with $3.2 billion in inflows. Also, the sector energy spider XLE also had inflows, about call it $306 million. But on the outflow side, we saw the DIA, the Dow Jones ETF, with about $427 million in outflows, and EEM, the MSCI Emerging Market ETF, also had outflows, about $278 million. Overall, most of the outflow activity was directed at some of those riskier types, and especially commodity-related plays. Well, the next group to take a look at is taxable bond funds. Again, they had about $900 million in outflows this week. This is their first outflow after 2 weeks of inflows, so a bit of a surprise that investors started to pull back at this time of the year. Although with tapering talk starting to heat up, perhaps investors, again, trying to get ahead of a softening market. Loan funds led all comers. They had $427 million in inflows this week. They have led most weeks throughout the year. No surprise, they'll probably be leading into next year as well. High yield funds also had modest inflows, about $57 million. Again, investors may be a little concerned about what effect tapering will have on the high yield market and credits in general. Generally speaking, the corporate, the mortgage, and international income categories tended to see outflows this week as investors were starting to get a little wary about things. The next group to take a look at, as I mentioned at the top of the program, was municipal debt funds. Had a whopping $1.9 billion in outflows. This is a sizable outflow for them. Not the biggest we've seen this year, but still a good number. They've had about 29 weeks of outflows now. Things just aren't looking like we're going to see an end to the outflow activity yet. This brings their year-to-date outflow figure to $55 billion, which surpasses the inflows into taxable bond funds this year. Let's not forget taxable bond funds still have inflows. 5 of the last 6 weeks have seen downside performance for municipal debt funds. So with bad performance and further concerns about items ranging from Puerto Rico to Illinois, it's no surprise to see mutual fund investors continuing to pare down their municipal debt exposure. It might make for an interesting play at the start of the year, but we'll have to see how markets start to shape up. The last group that we're going to take a look at is money market funds. Again, the lone bright spot in flows this week with $2.8 billion in inflows. We saw that retail investors were definitely more interested in cash this week. They put about $2.2 billion into those accounts, while institutional investors were tending to stand pat at the aggregate level. They only added about $600 million to their cash accounts. So overall this week, we saw outflows across the board, save for those money market funds, and even then, fairly light inflow activity to them. I think investors are just starting to wait things out and maybe trying to act a little bit early on to pull the trigger on selling rather than buying anything. Well, that'll do it for this week. Please join us next week where we'll see what happens over the next several days of flows activity, or feel free to join us online at any time at lipperusfundflows.com. We'll join us next week. Thanks.